Hello everyone. I'll be going through two of the challenging problems that you have in Connect this week. One of the problems, the statement of cash flows, is a problem that is presented twice in Connect using different data. So you'll have two statement of cash flows using different data. So if you follow the method I'll be going through, you'll be able to handle both problems pretty well. And then the other one, of course, is the discontinued operations, which is new material for us. But I'll be talking a little bit about the comprehensive income component now of the income statement, which is new. All right, so let's start with problem number 4.2. I've altered the data a little bit in the purple cells. Otherwise, the data is very similar to what you would see in the Connect problem, but it does change the answer significantly in the two cells I've changed. We're giving a bunch of data here, and this is information that we're used to seeing. We have data for 2021 and data for the previous year, 2020. One thing I want to mention is that we have to assume, in this case, that the division was held for sale in 2020 as well. That's important because it informs us as to how to handle the income from discontinued operations for 2020. So that's really an important notation for us. I'm just going to show that to keep that up. All right, in the green shaded cells is the data they gave us in the problem. Purple, as I said, is data they gave us but that I changed in this demonstration. And the gray cells are calculations which often affirm what they have given you in the problem. The gray cells are generally intermediary calculations, and then the cells in yellow are the final answer. Okay, so let's take a look then. They've given us all this data regarding the performance of the company. And of course, what's new is we have a pending sale of this division. So the division, as we've talked about in class and as you've seen in the videos provided in Connect, and as well as in the content in the chapter, that we need to know when the division is held for sale. So in this case, it's held for sale both years. So it's considered a discontinued operation for both years. So again, we'll just calculate some of these intermediary calculations. Net income is given to you, but I recalculated it again because, like I said, I've changed some of the data, so that will change some of these intermediary calculations. All right, we've got the net income. We've got the sale price of the division assets, which I've changed to $4.9 million. Book division of the asset stays the same. That's important for us. It's important for us to know because we're going to need that to calculate any gain. And in this case, we're going to have a gain on the sale of the asset. All right, so again, there are two components we need to consider for discontinued operations. One is the income produced by that division while we're spinning it off or getting rid of it. And then finally, the second component is the gain or loss on this actual sale of the division, which will occur in the year that we finally close out and completely spin off or get rid of the division. All right, so those are the two components. In 2020, we'll just have the income produced by the division. In 2021, the year of the closing of the transaction, the actual sale of the division, will have its earnings during the year for this division, as well as we said, we have to consider the sale price of the assets and then any gain on that sale. All right, so that's what's new in this chapter that's been covered. Now let's take a look at the first component here. They've asked us in the first component of problem 4-2 in the end of the text, and this ties with your Connect problem, is to prepare a revised income statement according to GAAP, beginning with income from continuing operations, and we'll ignore earnings per share, earnings per common share information. So that's what I've done. I've started from income from continuing operations. In this case, it's before taxes, because that's what they state. And so I've calculated the income from operations before taxes, and that's just a matter then of taking the sales revenue and then deducting out the various components, various expenses. And in this case, we have to take out first of all, we have to take out the income from the division this year. I'm working on 2021 here, column L. They included the income, as it says in the problem, from the division that's being discontinued. We have to break that out separately. So when I'm determining income from continuing operations, I cannot consider the division's operating income. That's got to be considered, as we said, separately down below. So we got to take that out. Also, what we take out then is the cost of goods sold, and we'll take out the operating expenses. So that gives us our pre-tax income from operations, using my numbers of $2.69 million for 2021, which is the year I'm concentrating on. Your numbers, of course, will be different in Connect. Your answer will be different because I've changed the data. Now I have to calculate the income tax expense, which will be 25% of $2.69 million. Deduct that, and I have my income from continuing operations of $2,017,500. And again, feel free to stop and replay the video as we go along if you have any questions. Well, now we've got our income from continuing operations. Now we consider the discontinued component. And that's what's new for us. And that's what we covered in this chapter. So what are the components? Well, there are two in 2021. As we said earlier, there's the income the discontinued unit or division produced during the year, and then we have a gain on the disposal. And you'll notice that I have listed them both net of tax. So I've essentially taken 75% of the income that was produced during the year of $410,000. That is 410,000 times 1 minus 0.25. Okay, so I've taken 75% of 410,000. And then when I get down to the gain on disposal, that's also reported net of tax, as we talked about in class and in the videos that were provided in Connect. So we had a gain of $600,000, and 75% of $600,000 is the $375,000, or $600,000 times 1 minus the tax rate of 25%. All right, so now we've got our after-tax income from the discontinued component, as well as the after-tax gain on the sale. So we have income from discontinued operations, which is the sum of these two components, at $682,500. So what is our net income in 2021? We're going to add our income from continuing operations of $2,017,500 to the $682,500, the income from discontinued, and now we have our net income using my numbers of $2,700,000. Moving on to part 2. It says, assume that on December 31st, 2021, the division has not yet been sold. The fair value of the division's asset was $5 million. In part 2, if it has not been sold and the assets are marked up to $5 million, and remember the book value on these assets is only $4.4 million. What do we do with that gain of $600,000? $5 million minus the $4.4 million. And the fact is that if this has not been realized, that is to say, we have not sold the division in 2021, like we did in part 1 of this problem, we do nothing with that gain. We do not recognize gain until they're realized. So in part 2, everything is the same, except that we do not recognize this $600,000 gain in the discontinued operations component. It just isn't here because we haven't sold the unit yet. In part 3, however, we're going to do the same thing again, but in this case, we're assuming that the fair value is down to $3.9 million. It's dropped. Now we're anticipating a loss of $500,000 because the $3.9 million fair value is below the book value of $4.4 million. Well, even though we haven't sold the unit, if we anticipate a loss, however, we must recognize that immediately. In part 2, we anticipated a gain even though we haven't sold it. We do nothing with it, do not recognize it. However, with a loss situation, if we anticipate a loss even though we have not sold the division yet, we must record that loss. Another characteristic of part 3 is that there is a tax benefit to this loss. So when we go down to the discontinued component and we're looking at what has changed, well, income from operations hasn't changed, but what has changed is this $500,000. So the after-tax cost of this loss is only $375,000, which is 75% of $500,000. And again, the 75% is the $500,000 times 1 minus 0.25, and 1 minus 0.25 is 0.75, or 75%. So we get a tax benefit here. The loss is deductible on our taxes. So we aren't going to really realize a full $500,000 loss. We're only going to recognize $375 because of the tax benefit of being able to deduct that loss. Remember, in discontinued operations, unless they state otherwise, we will generally report these items net of tax. And in this case, for the loss, we have a tax benefit on the impairment. Okay, then just mathematically, we carry down the numbers. One thing to note on part 2 and 3 is that in the first part of this, of the income from continuing operations, there's no changes. They will stay the same in each component going down. The only thing that changes is the fact that in part 2 and 3 we have not sold the unit in 2021, and therefore what do we do with a gain situation like part 2? Well, we do nothing. We don't recognize and anticipate a gain. Part 3, we have an impairment loss, and that we do recognize, net of tax benefit. And then mathematically carry down your values. Okay, so in part 2 and 3 there's been no completed sale. In part 1 there was a completed sale in 2021. In the next video I'll go on to problem 4-11.